Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Kforce Inc. Annual Report. Kforce Inc. offers a diverse range of professional staffing services and solutions to its clients across the United States. The company operates through two primary segments, Technology and Finance and Accounting, FA. The Technology segment provides talent solutions in various areas, including systems/applications architecture and development, data management and analytics, cloud architecture and engineering, business and artificial intelligence, machine learning, project and program management, and network architecture and security. These services cater to clients from multiple industries such as financial and business services, communications, insurance, retail, and technology. The FA segment offers talent solutions in areas like financial planning and analysis, business intelligence analysis, general accounting, transactional accounting, business and cost analysis, and taxation and treasury. Additionally, the company provides consultants for lower-skilled roles including mortgage servicing, customer and call center support, data entry, and other administrative tasks. The services of both segments are utilized by clients from various sectors like financial and business services, healthcare, and manufacturing. Kforce Inc.'s extensive range of services makes it a comprehensive staffing solutions provider in the United States. Unfortunately, I don't have access to the text you provided. However, I can still provide a general essay on what might cause a stock price to drop significantly. The decline of a company's stock price is often a complex issue with multiple contributing factors. One possible reason for a significant drop in Kforce Inc.'s stock price could be poor financial performance. This may include declining revenue, reduced profitability, or increased debt levels that make investors wary of the company's future prospects. Another potential cause of a stock price decline is changes in industry trends or market conditions. If the staffing and consulting services sector experiences a downturn, Kforce Inc.'s stock price may suffer as a result. Additionally, external factors such as economic recession, regulatory changes, or global events can also impact a company's stock performance. Internal issues within the company itself can also contribute to a decline in stock price. This might include poor management decisions, lack of innovation, or failure to adapt to changing market conditions. Furthermore, if Kforce Inc. experiences significant executive turnover, leadership instability, or other internal conflicts, it could erode investor confidence and lead to a drop in the company's stock price. Ultimately, the reasons behind a decline in Kforce Inc.'s stock price are likely to be specific to the company's circumstances and may involve a combination of these factors. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, solutions-oriented engagements that cater to evolving client demands, particularly in technology resources such as AI and innovative technologies, play a significant role. The strategic application of technology to remain competitive and deliver value to customers, clients, investors, and employees is also crucial. The expansion into technology services and solutions space, increasing demand for skilled professionals, and implementation of Microsoft Dynamics and Workday to enhance productivity and efficiency are other key drivers of revenue growth. Integrated strategy efforts, establishment of an offshore delivery capability, adoption of AI, client relationships with Fortune 500 companies, focus on technology staffing and solution services, breadth of service offerings, pricing power due to client-vendor consolidation efforts, and ability to provide timely access to highly qualified talent also contribute to revenue growth. On the decline side, ongoing macroeconomic uncertainties since the second half of 2022, shedding of technologists hired during the immediate post-pandemic boom, early phases of technology disruption with generative AI, decreases in consultants on assignment due to macroeconomic uncertainties and technology evolutions, lower profitability levels, higher capitalized implementation costs related to cloud computing arrangements for Workday, and payment of 2024 federal income taxes that were deferred are the primary drivers. The net income of a company has experienced a significant decline over the past 2 years. In 2023, the net income was $61 million, but by 2025, it had decreased to $34.8 million, representing a drop of 30.9%. This decrease is also reflected in the year-over-year comparison, where the net income dropped by 12.3% from one year to another. The decline in net income has been accompanied by a reduction in profit margins. The gross profit margin decreased by 20 basis points to 27.2%, while the flex gross profit margin dropped by 10 basis points to 25.8%. This decrease in profit margins is attributed to the macroeconomic uncertainties and the overall decline in net income. The technology segment also experienced a decline in its gross profit margins, with a 10 basis point drop to 25.3%, not specified in the text. The total gross profit percentage decreased by 20 basis points for the year ended December 31, 2025. These changes indicate that the company is facing challenges in maintaining its profitability and revenue growth. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. According to the latest figures, the company has achieved positive operating cash flow of $61.6 million in 2025. This is a substantial increase compared to previous years, demonstrating the company's efficiency and effectiveness in managing its resources. The data on page 20 highlights this achievement, showing that the company has successfully generated a significant amount of cash from its operating activities. Furthermore, the summary on page 39 confirms this trend, stating yes, with a figure of $61,645, which reinforces the notion that the company is indeed generating positive operating cash flow. This development is a testament to the company's financial health and stability, providing a solid foundation for future growth and expansion. The ability to generate positive operating cash flow enables the company to invest in new opportunities, pay off debts, and reward shareholders, ultimately contributing to its long-term success. The company's financial health has undergone significant changes over the past 2 years. A notable increase in debt level is evident from the data provided. The credit facility outstanding at December 31, 2025 was $66.4 million, a substantial rise from $32.7 million in 2024. This increase is also reflected in the long-term debt under the credit facility, which rose to $66,400 in 2025 from $32,700 in 2024. Furthermore, the company's interest expenses have also seen a significant surge. The interest expense, net for 2025, was $3,122,000, a substantial increase from previous years. In fact, the data shows that interest expenses rose from $1,900 million in 2023 to $3,100 million in 2025. This indicates that the company is shouldering a heavier burden of debt-related costs, which may have implications for its financial stability and future prospects. The company has made significant moves through acquisitions and divestitures in recent times. On the acquisition front, one notable deal was the purchase of Kforce India in Pune, India. This strategic move is expected to boost the company's presence in the Indian market. In terms of divestitures, the company has sold a 50% non-controlling interest in Workel Lama to an unaffiliated third party for $6 million. This decision marks a significant shift in the company's portfolio and is likely aimed at optimizing its resources and focus on core operations. The company's financial activities have been focused on rewarding its shareholders through various means. One of the key strategies employed by the company is paying dividends to its investors. This move not only demonstrates the company's commitment to its stakeholders, but also provides a tangible return on investment. In addition to dividend payments, the company has also taken steps to increase shareholder value through share buybacks. By purchasing back shares from the market, the company reduces the number of outstanding shares, thereby increasing the value of each remaining share. This strategic move is aimed at boosting investor confidence and providing a potential long-term benefit for shareholders. That concludes the financial summary for Kforce Inc. Feel free to comment below, and I will be happy to answer them when possible.